on December 13th and 14th, where we are expecting the central bank to raise rates another 0.5%. Joining me right now is Toggle co-founder and CEO, Jan Szilagyi. And Jan, it's great to see you. Jan, thanks very much for being here this morning.
Thanks for having me back.
All right, so what are your thoughts on the macro story and the impact of these rate hikes so far?
So I think, as we've seen from the jobs number on Friday, the economy is still above the speed limit that I think the Fed is trying to get it below. In particular, I think that the wage growth is highlighting that the inflationary pressures have not gone away. So yes, we've slowed, but I don't think we've slowed enough, and I think markets are starting to realize that now.
So right now, you've got layoffs happening in tech. You've got layoffs happening in PepsiCo. Hundreds of workers going to be cut. And in North America headquarters in the snacks and beverage businesses. How significant a slowdown are you expecting? The company's announcing it's going to be cutting costs earlier in the year, and now we've got this jump in quarterly sales and profits. We are expecting more layoffs, as per the Wall Street Journal, Jan. But that's on top of all the layoffs we've seen in tech. So how much weaker do you think the macro story gets?
I think it's going to get a lot weaker, but I think in part it's going to get a lot weaker because I think the Fed increasingly is going to be pushed to do a lot more than what markets are currently expecting. The reason being that if you look at the layoffs that have been happening so far, I think they have been predominantly concentrated in the tech space, right? That's the space that I think has gotten over its skis. It's now pulling back. What you are not yet seeing is the rest of the economy doing similar kinds of layoffs. And in terms of the amounts, every month there are millions of people that change jobs. So a 20,000 layoff actually, in the grand scheme of things and in the scope of the economy, actually isn't enough. I think the Fed is going to have to do more. What I think is interesting, just from the numbers that we saw last week, what we did and looked at Toggle, is that you can see that now the single most important driver of wage growth is inflation expectations. And so the Fed has to be seen as being tough on inflation. That's the only way that you create the kind of forward guidance that gives people confidence that this is a temporary situation, that we could get back to 2-3% inflation by maybe sometime year end next year.
Yeah, especially since the Fed is like the only game in town in terms of, tamping down inflation. You've got more spending coming out of the White House.
Exactly.
Mark Tepper is here. Mark, jump in.
Yeah, Jan, it seems like really the only way for the Fed to control inflation and to control these rapid increases in wages is to break the jobs market. And I mean, that could lead to unemployment rates of 6, 7, maybe even 8%. Is there another strategy for them to control this, or do you think they have to break the labor market?
I think ultimately you have to get to a point where the labor market just softens substantially. You cannot have 5% plus wage growth and 2% inflation. And I think you're not going to get there when the unemployment rate stays at 3.7%. It needs to get quite a bit higher. And so in my mind, they do have this window of time. We are now past the midterm election. We don't have the next election for quite some time. And while the labor market is strong, I think the pushback against them doing more is going to be a lot less. So they have a unique opportunity to really tighten as much as they can. It'll be interesting to see. The CPI report comes out the day that they start their meeting. So that obviously is going to inform quite a lot what the next move is going to be and what they project.
Yeah, that's a great point. The CPI is out on Tuesday. That's day one of their two-day meeting next week, Tuesday and Wednesday. Jan, how do you want to be positioned in the portfolio at this point, having said all of that? We've seen this little mini rally in the last month and a half, markets up in the double digits just since September 30th. Does that continue? Does that have legs into year end, or do you want to be selling into rallies going into what appears to be a tougher year economically speaking for 23?
So it's a great question. I think, and a few weeks back, actually right around the midterm election at Toggle, we did quite a lot of data crunching, and we told our users that one of the things that usually happens post midterms is there is a big catch-up rally, which more or less has played out. You typically get a 6 to 7% rally after that. The issue I think we're facing is that despite the fact that Q4 is typically the strongest quarter for the market, we have gone way beyond that. Typically you get 4 to 5%. And we're up 11.5% on the quarter. So I think there is definitely substantial case to be made for a correction. and continuation of the bear market trend. The best quarter prior to this one was 98, and if you remember back then, the Fed had actually cut rates 3 times because of the LTCM and Russian financial crisis and so on.
So sell into rallies ahead of what could be a deeper recession in 2023.
That's exactly right.
Yeah. Jan, any other alternatives to stocks in your view? What would a portfolio look like if you wanted to have access and exposure to other things away from stocks? Are there areas to hide?
Well, actually, I think, one thing that is actually making stocks less attractive is the fact that yields are now high enough where, except for, of course, your bank savings account, you can actually find fixed income products where you'll be getting 4.5%, and potentially park some of your money there. I don't think that's a bad idea at all, especially again going into a recession, because eventually some of these yields are going to go lower, and so you'll make money on that portion of the portfolio too.
Yeah. Mm-hmm. Go ahead.
No, please. So,
No, I'm looking for alternatives. Go ahead, Jan.
Yeah, so that, I think that would be effectively one of them. I think there are obviously some other assets out there that you can look at, but I think people are going to shy away from cryptocurrencies and some other assets at the moment, just because obviously the what's happened there is burned to quite a lot of people.
Yeah, and real estate, of course, has been decimated by 7.25% mortgage rates, even if they are off of the highs.
Yes.
Jan, it's great to get your take. Please come back soon. We so appreciate your time. Jan Szilagyi joining us this morning. Thank you from Otago. Quick break.